Stanford University.
This week is kind of the second part of what we have called Introduction to the World of Venture Capital. So last class we talked about GP-LP dynamics as well as VC firm composition, structure, governance, and today we're specifically going to cover all of these topics. We're going to run through them as quickly as possible, but also have a chance to ask questions, be very interactive, and answer any questions you have. So first topic would be sourcing deals and finding investment opportunities. So you've made it, you're a VC now, you're looking to do your first deal. How do you actually find that deal? How do you actually make that investment happen? 2, term sheet basics. So you've finally sat down on the table, decided that you want to negotiate with this founder. What are the key terms that you should be looking out for and kind of the things that you should be fighting for? Third aspect is dynamics of negotiating a financing round. Fourth is portfolio management. So how do you actually decide on which companies to spend more time with? How do VCs in general decide on which companies to spend more time with? And then fifth topic is getting into VC and staying in VC. So this is a question that we get asked pretty much every single year and want to address that. And I think the ways for getting into VC is unique and different for every single person. And then finally, if we have time, we'll discuss the state of VC today. Are we in a bubble? What are new trends that are happening? AngelList, for example, is one disruptive thing that's only been around for the past few years. So what exactly is the state of VC today? Okay, so sourcing deals and finding investment opportunities. So VJ is the world's most desperate venture capitalist, and he says, you two have good math grades. If you grow up and marry and produce a little engineer baby, I want to invest in its first idea. And the couple is like, you know, we're already looking for later stage funding. So I think that does ring true in terms of first question, in terms of how do VCs find investment opportunities. So traditional thinking for that is, you're a VC, you have a bunch of money, you want to find the best startups to invest in. Maybe you start off by looking at the App Store, you look at App Annie, you see what apps are performing the best, like which ones are really gaining traction, blowing up. Maybe you look at TechCrunch, maybe you look at Crunchbase, you notice that this company just got funding from all these prominent angel investors and you want to put in additional capital to lead their Series A financing round. Or maybe you're attending a demo day, Y Combinator demo day, other incubators, other accelerators, and you want to get a peek at kind of what startups are coming out from that. So I think the most important thing when thinking about how do you source deals and find investment opportunities is you want to do whatever everyone else is not doing. So if you think about it, App Store metrics, demo days, what's available online, what's available on Crunchbase, TechCrunch, everyone else has access to that information as well. You want to do what everyone else is not doing. So specifically, for example, you want to have a strong network of other investors who might be co-investors, angel investors, founders that you've backed, who might know from the very beginning when someone's going to create a new company. You want to have a really strong network of people and kind of be, those people be your eyes and ears to actually actively sourcing and finding those investment opportunities for you before they become public, before they have their first TechCrunch article, before they present at demo day. So a couple ways for doing that include that I've seen that have been very successful is, for example, we met David Hornick a couple weeks ago. So he organizes an event every single year called the Lobby Conference. If you Google search the Lobby Conference, you'll see that a number of people have attended, including, I think, Mark Zuckerberg was an early attendee, co-founder of Zynga was an early attendee, and he organizes this event in Hawaii every single year. Part of the reason why we also don't have class in 2 weeks, since I'm going to that, but just an opportunity to basically be able to form a network and have an opportunity to talk to these individuals before they actually raise their next round of financing, start their next company. So hosting events, hosting dinners, hosting exclusive opportunities, that's one way in which I see VCs actually try to get the inside knowledge before it's public to everyone else. One thing that I've personally done is when I first started in VC, I noticed that a lot of VCs weren't targeting university campuses and specifically the research that was coming out of research labs. So the very first 2 investments that I did came out of Stanford PhD programs. One of the company actually ended up being sold to Apple, but it was just something that a lot of VCs didn't have that inside track into universities and what was happening in the university research lab, and being able to have a first insight on that and then see the company form and shape and be able to influence and direct that financing round was one strategy that I took. Yes?
A lot of universities and hospitals have some barriers because of conflict of interest and things like that. How do you, as a VC, overcome those hurdles to get access to students or professors?
Definitely, and I think Stanford is also a unique university in that there's so many students, undergrads, grad students who are starting companies out of that, and then there's the entire Office of OTL, Office of Technology and Licensing Office, and as someone who's working at Stanford, teaching at Stanford, like you don't want to be encouraging students to be dropping out of the university. So I think one thing that I actually find really interesting is that Frederick Terman, who I consider and a lot of people consider a godfather of Silicon Valley, he actually had this mindset very early on to actually encourage entrepreneurship and support it, but not push students to do it. And I think that's kind of the right mindset in terms of if a student has an idea, if they want to pursue a company, if they want to drop out, being supportive of what the student decides, but not pushing them to co-found a company with you or hire them as a co-founder to actually create a company or any of that. So, yeah.
So you mentioned VCs can start very early looking at some of this stuff. Do they ever come to hackathons or ideathons and stuff? And even encourage people to, you should take this a little further, and I might give you money too.
Yeah, all the time. I've attended a number of hackathons myself, and I think the number one thing and the reason why I attend hackathons is because finding really, really talented engineers and really, really talented individuals who have a vision to build a product is my top priority. And I would never kind of force a founder or force a potential founder to go incorporate and go start the company, but I will keep in touch with really smart individuals who are idea generators, who are just have that vision and support them as they're thinking about starting a company. But hackathons is a great way to also just, if we talk about sourcing deals, finding potential companies like hackathons are a great opportunity for that. Other questions related to that? Yeah.
Besides research now, what source of information are you aware of and find useful that most other people wouldn't know?
So I think that for sourcing deals, my primary source is actually just through founders that I've backed or other investors who I've done deals with before. And these include angel investors, co-investors in early stages of financing round. And then on the founder side, I think founders are extremely, extremely critical. So for example, I've had founders who I've backed who have gone through, for example, the Stanford Startup Incubator, StartX, or for example, Y Combinator, and they have that inside knowledge as a founder in terms of they're mentoring the current class of founders in StartX, in Y Combinator, before demo day even happens. They know all the list of companies that are about to present, and being able to have that inside knowledge before it's out in the public is really helpful, and they'll constantly recommend companies for me to invest in. So in terms of kind of another question, what do VCs look for in investments? Every single VC is going to say something along the lines of team, market, and product. And every single VC might say that they look for something different, but if you observe all of those responses, it ends up being somewhere along the lines of team, market, and product. So on the team front, I think the biggest thing is that ideas are very cheap, and oftentimes you'll have something that's been pitched 100 times, but it's only actually the team who can execute on that actually makes it a billion-dollar company. On the market front, you want to make sure that the founder is targeting and addressing a large market. So for example, if you're targeting 100% of a tiny, tiny market that's just focused on a specific breed of cats, that's not a huge billion-dollar opportunity. If you're targeting a ginormous market of, say, payments, and you're owning about 5% of that, and that's a multi-billion-dollar market, you're going to build a huge business out of that. And then on the product front, you want to be able to have a product that, one, has defensible technology. This might be through, for example, IP and patents and just very unique technology and research, or it might be through a killer UI and user experience. Okay, so we're going to take a short break. Stand up. So I think one of, this is a stretch as well, so I think one of the things that investors look for all the time is this founder visionary. So for example, Being at a place like Stanford, there's a lot of really smart individuals. You guys are all very smart, very high IQ, but do you actually have that vision in terms of if you're looking at the company 5, 10 years from now, what is the company going to look like? What is that broader vision? So, okay, let's do a fun exercise. Okay, try to pat your head and rub your tummy at the same time. So everyone has to do this. This is a fun exercise. It's also a stretch break. Okay, so keep patting your head, rubbing your tummy. Okay, so patting your head, this idea is being able to execute. So we all talk about founders need to be able to execute well. Okay, you guys can stop now. Okay, so being able to pat your head and execute and figure out what does product 1.0 look like. How can you actually build that product, hire the right engineering team, make that product happen, and have a very narrow focus on building that first version of the product. But at the same time, rubbing your tummy and being able to paint a vision of the future of the company, what's kind of the 5 and 10-year goal. Okay, sit down now. So that's just in terms of, I think vision is very, very important and critical. So next topic is term sheet basics. So we'll go back to VJ, the world's most desperate venture capitalist. So the entrepreneur, who's a dog, says, I need 100 billion to build an ocean city. And VJ's like, take my money, take it, take it. And then he asks, do I get stock or something? And the dog's like, maybe, maybe not. So when we're thinking about a term sheet, as a venture capitalist, there's 2 things that are extremely critical and important. One is the economics, and 2 is actual control. So as an investor, you might be giving $3 million to a company. What do you get out of that? First one, economics, you might be getting, say, 15% of the company, 20% of the company, a certain percentage of ownership. The second aspect is control. So for example, what exactly are the protective provisions that you're getting? What are the board control rights that you're getting? How can you actually influence the company and decide on where it goes? So in terms of, if you look at what a VC is getting, it's always 1 economics, 2 control, and specifically kind of the special terms and conditions for control include a number of the terms in the term sheet, which we'll go over. So these are a list of terms that you often see in a term sheet. So we'll go over each of those very quickly. A term sheet itself might be 2 or 3 pages. These are some of the key terms that you should always look for. The first and most important term is this idea of pre and post money valuation. It's actually a very, very simple addition. So pre-money valuation is how much is the company worth before you actually invest as a venture capitalist. So for example, a founder might argue that my company's worth $7 million. And then VC might agree to that, usually doesn't agree immediately. And then the VC might say, hey, I'm going to put in $3 million. So the post-money valuation for that is just 3 plus 7, which is $10 million. Keep in mind that the math isn't that simple, even though on paper it's very simple. In reality, the $3 million that the investor is putting in is worth a lot more than $3 million. There's this idea of smart capital. The VC is not just providing the capital, but also smart resources. And specifically, if you think about that, $3 million, anyone can provide a founder $3 million. All the cash comes from one place. The treasury prints it. At the end of the day, it's all the same exact dollar. But the $3 million that you're putting in, you're providing not just that cash, but also your network, your resources, your advice, your support, your time to actually help the founder grow, which is why later rounds of financing, the company valuation constantly goes up. So another term that's very important for VC investors is this idea of liquidation preference. And this is a way for VCs to get their money back. If they're putting in $3 million, liquidation preference basically means that I can get my $3 million back. And that's if the company sells. So keep in mind that this actually only matters if VCs sell, if the company sells below the valuation. If the company sold above the valuation, basically VCs get their $3 million back, they get additional dollars back, and the founder also gets an outcome out of that. So there's 2 types of liquidation preference. One is participating, and the other is non-participating. So participating is basically the VC gets not just the dollar amount that they put in, say $3 million, but they also get the percentage ownership and what that amounts to back as well. Say it might be 15 or 20%. That actually doesn't happen in the Valley at all. I don't see a lot of term sheets at all with that term. The other aspect is non-participating, which basically means the VC gets either their $3 million back, the amount of cash that they put in back, or they get back their percentage ownership, say 15%. And one company who absolutely hates liquidation preference and avoids it and only sells common stock is Snapchat. So occasionally you'll see rare exceptions to this.
Okay, two kind of related questions. The difference between common and preferred do you ever see voting right differences between the two? And then the second thing is, I think Andreessen Horowitz is like promoting this now, where they prefer founder CEOs or founding team to have majority voting rights. And so then you get into this whole, Google and Facebook have this different class of shares, which gives, even though the founders don't have majority equity stakes, they have majority voting rights. How does that play into, I guess, what kind of shares are issued?
Yeah, I think the specific situation you're referring to is when some of the best founders will negotiate and argue for super voting shares. So you have preferred, and then you have common, and then within common there's both super voting stock as well as your traditional common stock.
Within common, so there are different types of common, basically?
Yep.
Is that issued at like the time of founding, or is that negotiated as part of the? So
it's best issued at the time of founding, just for tax implications, but you could also have creative structures to issue it before the next round of financing. That's a good transition to the next term we have up here, board of directors. So this is a way for the board of the company to hold the CEO accountable, to hold and help guide the company. So typical structure that you see for a lot of early stage deals is you'll have, say for example, a 3-person board. There's one person who holds the common seat, who represents the company and is elected by the company. Usually the company elects the CEO to take that common seat. You have 2, an investor seat. So usually the investor, the institutional investor who's leading your financing round, who owns the majority of the preferred, will take that seat. And then 3, you'll have an independent seat, someone who is mutually agreed upon by both the common stock director as well as the preferred stock director, your investor seat. Later rounds of financing, that board might expand to, say, a 5-person board in which you have 2 people representing the company on the common stock side, as well as 2 investors representing on the investor side, the preferred side, and 1 independent seat. Occasionally you'll see for very, very hot deals that there might be a completely unique and different structure. So for example, you might have 2 common seats and 1 investor seat, or 2 common seats, 1 investor seat, and 1 independent seat.
Could you characterize the difference between a board of director and then a board observer? And then from the perspective of a venture capitalist, like why would they prefer one or the other?
So the board director has, at the end of the day, most important thing is the board of directors has a fiduciary responsibility to the company. So the board director is voting for all the matters such as approving stock option grants, for example, making key acquisitions, key hires. The board's approving all of that. Oftentimes, an investor isn't able to fight their way to actually get a board seat, but they still want to be able to observe the company, have some control of influence, and that's where they'll negotiate, for example, a board observer seat. So I think the most common way I actually see investors negotiating board observer seats is strategic investors. So if you think about a strategic investor, a large corporate VC fund, say for example, Samsung, Rakuten, other strategic investors, oftentimes founders don't actually want the strategic investor on their board voting on these different matters because, for example, the board approves on whether or not an acquisition goes through. If you have a strategic investor sitting on that board and actually deciding, do I want to sell the company to Samsung or to AT&T? Very likely that board director wants to sell the company to Samsung. So what founders will often negotiate is, for example, for a strategic investor, allow them to have a board observer seat to still, because they put in all the capital, observe and see what's going on with the company. But in general, founders definitely, investors definitely prefer to actually have that board seat.
And are there points where like it actually makes sense for the investor, for the VC to actually not take a board director, whether it's like a time issue. They don't necessarily want the commitment to go to this
Yep.
company for,
Yep.
so why not just become an observer? Or in your experience, I guess, how do you guys that?
So I think you hit a really good point in terms of time commitment. So if you talk to any VC, the maximum number of boards that they're usually on is anywhere between 8 to 10, maybe 12 or 15 if you're really aggressive VC per partner. So if you think about that, if you're deciding to actually lead a financing round, take a board seat, you better really, really like the company and really, really like the founder to be spending literally hundreds of hours with them, dozens of hours just on board meetings alone. So that's a huge decision on the investor front if they actually want to spend the time to be a board director. And then on the board observer front, sometimes an investor might actually use that as a way to train an associate, train a principal to actually sit in on those board meetings, observe, but not actually make kind of key fiduciary decisions for the company.
Is there typically compensation for board members or board observers?
It definitely varies per company, but some companies will compensate board directors with a separate kind of allocation of common stock on top of what the board director is already getting from the carry, from the fund for being a part of that deal. And then other times they'll, for example, like compensate travel expenses, accommodations for negotiating deals and whatnot. So, and same answer for board observer seats. So we're gonna move on and just go through some of the other terms. So protective provisions, NVCA, National Venture Capital Association, has a set of protective provisions that a lot of times investors will argue for. This includes, for example, a protective provision for the investor to decide and control on the sale of the company. So for example, you don't want the company to be sold for say $1 to your best friend or the founder's best friend. You want to be able to have that block to actually control that. Another common protective provision is around the next round of financing, making sure that the valuation for that round of financing as an investor, you want that to be higher than the current round of financing, the previous round of financing, and not a down round. So usually a protective provision around that. For example, another protective provision that's very common is any material changes to the business. So that can be argued and defined differently by the investor or the founder. But the idea is if you're funding a software company, you don't want the company to all of a sudden change the business into, say, a restaurant without you having that protective provision. So another term, right of first refusal. This is something that's not just one specific clause, but something that you'll see sprinkled throughout a term sheet. The idea for that is, as an investor, you want to have the right to refuse something, be the first person to refuse that. This often happens around the sale of secondary shares. So for example, you have an employee at a company, they're about to leave the company, they want to sell their shares, and the investor doesn't just want a random person to purchase those shares, but they want to have the right of first refusal, be the first person to actually have the option to purchase those shares. What usually happens is you actually have what we call a right of first refusal chain. So for example, the first person who can actually have the right to purchase those shares might be the investor, a certain percentage of those, and then it could be the founders have a certain percentage in which they can actually purchase those shares, and then it might be the angel investors, and then it might go all the way back around again. So another term, prorata, this simply means in proportion. It's a very commonly accepted term. There's basically nowadays no term sheet in Silicon Valley that won't have this prorata provision. So this basically means that today you're an investor, you're putting in, say, $3 million, purchasing 20% of the company. You want to be able to maintain that 20% ownership moving forward, especially as the valuation of the company goes up and up and up. So prorata basically means that in the next round of financing, say the Series B financing or the Series C financing, you basically want to be able to put additional money, additional capital at that valuation price in order to maintain that 20% ownership. So it's the right to be able to do that. Most important thing to note for that is, as we discussed very briefly, during the last class, this is a right that's a one-sided right in which the investor can decide whether or not they want to put in the prorata. The entrepreneur always has to accept for that. There's no way for the entrepreneur to actually force the investor to put in additional capital to get that continued ownership. So,
You said this is very common or not very common?
very common. Investors want to be able to have and maintain their ownership and put in additional capital to maintain that ownership.
I just had a question about funding of Prorata. My understanding is that in the year funds, VCs reserve funds for future funding rounds. Has it ever happened with it, particularly like Popular Stock, Facebook or something like that, where they run out of funds that they've reserved And then do they do cap calls on the LPs, or how do they handle it?
I think that brings on an interesting point in terms of, as an investor, say you have a $50 million fund, $100 million fund, you invest a certain amount of capital into new deals, and then you want to be able to reserve capital for especially those hot companies, hot traction companies that you want to put in additional capital, even though it's at a higher valuation, to maintain that ownership. And the good news is that, like, the best investors, they'll continue to raise additional funds and they'll be able to maintain their pro rata. But there are cases in which a VC fund isn't, just based on limited amount of capital left in that specific fund. Okay, so another term, drag along. So this is really important because there's this idea of when you're investing in a company, there's this idea of a majority investor versus a minority investor, and that's usually separated by a specific dollar amount that you put in. So for example, some term sheets, some deals will say that if you invest at least $2 million, you're considered a majority investor. Purpose of the drag along is you might have, for example, 50 angels who are each putting in 100K checks, and if you have a major decision that needs to be made at the company, such as sell or acquisition, you don't want to have all these 50 angels having to make a decision on whether or not, and voting to actually make that happen. But drag along just means that the major investor, the lead investor, literally just drags along all those other investors to make a decision. So, yeah.
Wait, is the majority investor the same as the lead investor, or what's that?
So they're not the exact same thing. So majority investor is just you're investing above a certain threshold, and that means you can have certain information rights, certain voting rights, just certain rights in general. And then the lead investor has all the rights of a majority investor, but usually also has additional rights, such as, most notably, a board seat. So we're going to try to run through these last two terms pretty quickly and cover some additional topics just because we're short on time. So this idea of employee option pool, we all have heard of the story of, for example, the Facebook cook who became a millionaire because he received some early options in Facebook. So idea of this is so that employees of the startup, employees of the company can actually win and participate in the upside of the company, especially as the valuation goes up and the company becomes very successful. Employee option pool is something that's always included in terms of, it's typically around 15 to 20% of the company is reserved for employees of the company. The way that investors and founders negotiate for that differs. So investors will always prefer that the employee option pool is created before the financing round. Reason for that is when you actually create the employee option pool before the financing round, you create a 15-20% option pool that actually dilutes everyone on the existing cap table, which includes existing investors, the founders, but it doesn't dilute the new investor in the company. When you create the employee option pool after the financing round, basically that dilutes not just everyone who's already on the cap table, but also the investor who put in capital, and it dilutes the investor as well. So depending on if the employee option pool is created post or before, post or pre, before the financing round, the investor can actually get some additional percentage points of ownership. So final term just to cover is this idea of no-shop agreement. So every single term sheet has this no-shop agreement, and the reason for that is you want to do all your shopping or all your kind of figuring out which investor you want to have before you actually sign the term sheet, because once you sign the term sheet, the no-shop agreement could be anywhere from 30 days to 90 days or somewhere kind of within that range or outside of that range. And the idea is that the investor still has a fiduciary responsibility to their limited partners, to their investors, to their LPs, and they want to make sure that they do the diligence in terms of legal diligence, tech diligence, background checks, and most important reason why the no-shop agreement exists is because a term sheet is not binding at all. At the end of the day, the investor doesn't actually have to go through with the financing. More than often, the investor always goes through with that financing because their reputation is on the line. Silicon's very small. If you're signing all these term sheets but not going through the financing, it looks very bad on your part. But also, the no-shop agreement is a way for investors to do additional diligence and make sure that the founder isn't shopping around the term sheet and trying to get a better deal.
So the term sheet is like a letter of intent, like it's not binding? You're just saying within this period.
Exactly. So that's good question and super important because the term sheet is not binding at all. It's there's no obligation to actually finance the company. From the term sheet process, founders and investors go into the final doc stage. A term sheet is usually only about 2 or 3 pages. The final docs are a lot lengthier, 10, 15, 20, 30 pages. And once the final docs are signed and the money is wired, that's when you actually have the deal done. Okay, next topic, dynamics of negotiating a financing round. I'll first cover very briefly the process for how a deal actually gets done. Very first stage is sourcing. So as an investor, we talked briefly about how you actually source a deal. This is just constantly on the lookout, trying to find the best company possible. And then after that, what usually happens is the one VC, the one partner at the VC fund will start talking to that founder, start engaging, start having a conversation, actually consider whether or not they want to invest. If there is some sort of interest, the next stage after that is that it usually goes to what we call the partnership, the partner meeting, in which the founder actually goes in and pitches the entire partnership at a VC fund. That's incredibly important because VC funds operate as partnerships. So usually the voting structure for how a deal actually gets done in the Valley is that you want to have some sort of consensus, some sort of major consensus amongst all the partners at the VC fund. So that's when the founder actually goes in and pitches the rest of the partnership. There are some cases in which a VC might have, for example, a silver bullet or an ability to do one deal a year that the rest of the partners don't have to agree on. After the entrepreneur has pitched the partnership, and this usually happens on Mondays right after the Monday partner meeting where all the VCs, all the partners are actually in the office that day. Once that happens, what will happen is just some light form of diligence, usually, some light form of tech diligence, just in terms of seeing that this is actually a viable investment. From there, we go into the term sheet negotiation, in which the VC and the founder will together lay out and decide what are the key terms. Most of the terms, all the terms that we covered just now in terms of what's the valuation of the company, how much is the VC going to own, what are the rights, is there a board seat, who else is participating in the round, just like general basic terms based on that. From there, we talked about the no shop provision. From there, the VC will do additional diligence. This includes, for example, additional tech diligence. If you have IP and patents, the VC will have a lawyer actually make sure that you actually have those IP and patents, or they might do, for example, background checks, security checks. They will do legal diligence, look through your incorporation documents, look through all of your documents to make sure that everything's right and in order. And then from there, there will be what we call the final docs that are drafted. So everything that's laid out in the term sheet is then put into final docs, written out into lengthy, the question you asked was kind of lengthy 10, 15, 20 page docs. Once that's signed, the money is wired, and then that's when the deal is actually complete. So the deal is never done until you actually have the money wired and in the bank. So that's kind of the basic process in terms of from start to finish of investor meeting the founder for the first time to the money actually being wired in the bank account. Questions on that process? Yeah.
What's the time span typical time span between the term sheet being signed and the money being wired?
Mm-hmm. So that can range anywhere from, I would say, 3 days, 1 week, up until a month or more. And the process I outlined is what usually happens for the lead investor, the person who's leading the round. If you're, for example, a co-investor, sometimes those deals can happen as quickly as 1 day, 6 hours, in which you're throwing in a small check of $50K, $250K, and you don't have to go through that entire process because the lead investor is setting the terms, negotiating the terms, putting together the final docs, doing all the tech diligence, doing all the legal diligence, and you're just following on with a small check. So, questions on that? So I think one thing that's really important to note for this entire process is that it's a very delicate balance between your VC partner, you're in the middle, standing between one, the founders who you want to invest in, and two, your partners at the VC firm. So the founders want, say, like $100 million valuation. Your partners at the VC firm want, say, a $50 million valuation. And your job is to be in the middle, and in order to get the deal done, it's a very complicated and intricate balance between making sure the founders are satisfied and making sure your partners are satisfied. And I think that's probably the most complex aspect of being a VC partner, and is actually bridging those two and making that deal happen. Yeah.
So is that an example of you shopping a term sheet, or in the middle are you arguing different things with different people?
So the no-shop agreement only exists once you actually sign the term sheet. Okay. So before then, you can collect as many term sheets as you want before you actually sign one. And it's actually, I actually encourage founders to do this. being on the founder side in terms of if you want to get the best valuation possible for your company and you have additional multiple term sheets on the table, that sets the market and VCs respond to that. So just covering a couple additional topics very quickly. Portfolio management. So you've invested in a dozen companies. How do you actually manage the portfolio? The strategy that all the best VCs take, and it's actually very important to note as a founder, is VCs want to spend most of their time with their very best companies. So if you're a company if you look at all the companies that the VC has invested in, if you're the company that's struggling the most, the VC likely doesn't want to spend time with you. They want to spend time with the top 2 or 3 companies that they've invested in. That's also really important in terms of deciding on which VC to go with. For example, if you're going with a VC who has already, say, like 10 other companies, and then you're going to be the new company that comes in and the VC just doesn't have time to spend with you or just doesn't want to spend time with you, that also influences the outcome of your company. So I think most VCs, if they look at their portfolio, at least I like to categorize it in terms of 3 ways. One is the unicorns. So we love unicorns. They're magical. They're worth $1 billion+. VCs want to spend time on unicorns. 2, I like to categorize companies as dragon eggs. So companies that have the potential to grow and become unicorns, they have a lot of potential to hatch and become, say, a unicorn. And 3, the company that you don't want to be within a VC's portfolio is a walking dead company. So a company that's just continuously walking, completely dead, has a steady kind of revenue strategy, steady growth, but just isn't having that explosive, what we call hockey stick growth, that explosive growth to become a $1 billion company. So I'm just going to read out this activity for you to think about, and we can discuss it next class, or if you want to talk to each of us individually about this. This is just an interesting exercise to think about that does happen in Silicon Valley. You're the founder of a mobile analytics company and have spent a lot of time figuring out which VC to choose. You make the choice to go with Vulture Capital and close your hot $15 million Series A financing. And then a few months post the close, the specific VC partner you chose to sit on your board leaves Vulture Capital. What are the dynamics and what should you do? So just food for thought. One final topic we'll just cover very, very briefly is this idea of how do you get into VC in the first place. Getting into VC, I think the most important thing to note is that there's absolutely no job application to become a partner at a VC firm. However, I think at the end of the day, anyone can become a VC, and there's multiple ways to get into this. One common path I've seen is, for example, you've entered into Silicon Valley, you're starting to do a couple angel deals, you've invested in some really hot companies and have built a network around that and provided value to those companies. Other VCs who then put on additional capital into those startups that you've invested in take notice of you, and they might ask you to join that VC fund with them. Another strategy is, for example, you've built a company, you're one of the portfolio companies of that VC fund. You might not have that $1 billion exit, but you've shown that you've been very good at making key product decisions. You returned your VCs back their money. You have a vision, you're very smart, you're very technical, you're able to make good decisions. And instead of being the CEO of the next publicly traded company, instead you might join that VC fund because you've had a good relationship with the VC who invested in you, like you had good board dynamics, and you might join the VC fund that way. And then another instance is, for example, you're an executive at a hot, fast-growing startup, and you decide to leave that company and you're hired into a VC fund that way. I think at the end of the day, I think the most important thing is that there's no job application for it. It's all about your network, your presence, your ability to be a partner to the VC and just be able to work on deals together before you actually join the fund, be able to get to know the VC. And at the end of the day, a VC firm is a partnership, and no one wants to work with someone unless they've gotten to know them for a period of time. I'll close with one final note in terms of once you get into VC, it's not a permanent job. It's not a job of a lifetime. Keep in mind that VCs raise from LPs. LPs only want to invest in VCs and VC firms who actually generate a return for them. You have to actually be able to close deals and get returns in order to stay in VC.